In this video, we're going to talk about solo 401k contributions for sole proprietors, single member LLCs, and 1099 contractors. We're going to talk about the specifics regarding solo 401k plan contributions, self employment income, and making what's commonly called the mega backdoor Roth contributions. Please keep in mind the information shared in this presentation is for educational purposes only. I advise you to speak with your financial professionals about how to apply this information to your specific situation. So the focus of this presentation is going to be about the eligibility of contributing to that solo 401k plan. What are the contribution limits? How to calculate the employer contributions in a solo 401k plan? What's included in self-employment income? What type of contribution can you make to that solo 401k plan? And more about those voluntary after-tax contributions that are commonly called the mega backdoor Roth. So a solo 401k is for an owner-only business who has no full-time W-2 employees. There is one exception. The owner's spouse may also contribute to the plan if they are working in the business as well. Now, the solo 401k contribution limits are based on a couple of different factors. One being the self-employment income that you're reporting on your tax return. Your age is also a factor, whether or not you're able to make those catch-up contributions. Whether you contribute to another retirement plan, like if you have a 401k plan through a day job, that influences your ability to contribute as well. And the type of contribution that you're making, whether this is an employee versus an employer contribution, whether those are pre-tax, Roth, or voluntary after-tax contributions. So the employer contributions are not affected by contributions you make to other 401k plans. The limit on your contributions is equal to 20% of your self-employment compensation for sole proprietor, single member LLC, and 1099 contractors. We're going to get into other details on S corporations and how those are calculated a little bit differently in another video. So this is specific to those sole proprietors, LLCs, and 1099 contractors. The aggregate limit on those contributions cannot exceed the overall limit. So in 2024, that is $69,000 for the plan. And if you're over age 50, it's $76,500. Now in 2025, there's actually a couple different numbers. The overall plan limit increased to $70,000. And if you're age 50 and up, now you can contribute up to $77,500. But they also made, under the Secure Act, basically a super catch-up contribution in 2025. And if your age is 60, 61, 62, or 63, your total plan contribution limit is now $81,250. Once you pass age 63, it actually reverts back to the other plan limit, which is the $77,500. You are not impacted by contributions that you make to another retirement plan unless they were made to a 403B. So that can't exceed the overall plan limit. The self-employment income is based on your net income that you're reporting on your Schedule C of your 1040. And that is after you're reducing that net income by half of the self-employment tax. But this does not include W-2 wages from other sources. So if you had an outside day job, you would not be able to include that as part of your self-employment income for purposes of calculating your contribution. It also does not include investment income. So things like dividends, interest, and capital gains that may have been realized this year are not included in that calculation for self-employment income as well either. So what type of contribution can you make to a solo 401k plan? A solo 401k, it has the highest contribution limits of any of the defined contribution plans that are available to self-employed individuals. And that's because you get to make both the employee and the employer side of the contributions. The employee contribution can be either a pre-tax, Roth, or the voluntary after-tax contributions. Those employee contributions can be impacted by those contributions to other 401k plans. The contributions that you're making to another plan, they do reduce your ability to make contributions to your solo 401k. So if you max out contributions in another plan, you won't be able to make more employee contributions to your plan. But the employer limit actually applies at the plan level. So this is a difference. Those employer contributions, those can be applied as pre-tax contributions. Under the Secure Act 2.0, they can also be applied as Roth, but you have the ability to do voluntary after-tax contributions, so it's kind of a moot point. And it's not affected by contributions that you're making to other 401k plans. Now, the voluntary after tax contributions, I separated those out here because I wanted to make the point that these are part of the employee contribution and overall limit category, but they are not impacted by those contributions that you're making to another plan. And so this is how you go about making that mega backdoor Roth contribution. Those voluntary after tax contributions may be transferred to a Roth IRA, whereas employer contributions may not be transferred out of your solo 401k to a Roth IRA until that triggering event has been met. So, for example, the attainment of age 59 and a half. So, here's a couple of rules regarding this type of contribution. So, the contribution is not tax deductible because it's considered made with after tax or post tax dollars. When those voluntary after tax solo 401k contributions are then converted to a Roth IRA or a Roth solo 401k, that conversion has to be documented in writing by completing a conversion form. And the IRS expects to see that form if they ever ask for it. And then a Form 1099-R has to be issued to report that conversion, whether taxable or not. This is why that conversion to voluntary after tax solo 401k contributions are commonly called that mega backdoor Roth solo 401k. It's important to note that gains that accrue inside the account are taxable. So most people will move these funds and convert them to that Roth solo 401k or Roth IRA before they invest them. So that way they can grow tax deferred and continue to grow tax free. We're going to run through a few examples and calculations in our next video to help you bring this concept to life and see how you might be able to apply it to your specific situation.